underwriting an apartment deal. And I'm your host, Devin Elder. Abel Pacheco, also your host this evening.
One moment.
So the vision for this meetup, obviously we're not meeting in a room, but hopefully soon we will be meeting in a room once a month. We started this meetup. Abel, you want to kind of give everybody a little bit of an overview here?
Yeah, absolutely. Hi everyone, Abel Pacheco. I'll do an introduction in a minute, but as far as the multifamily meetup, we came together a little, under a year ago ish, here in San Antonio, Texas, and originally the goal was to try to create one group community here in San Antonio, Texas, that was doing deals here locally in Texas and the surrounding areas, was to try to put education together for investors, whether they were passive or active, and build that community or that ecosystem. So I think the multifamily meetup, very much accomplished its goal. And now that with COVID, the pandemic, we started, or it enabled us to launch the internet side of it. So webinars, we're conducting these, once every 2 weeks, a lunch, and also an evening. And man, it's just been a great opportunity for us to give back and serve some of our investors that want more education, more information on how to analyze a deal, how to find new operators, how to invest safely, passively, or launch a career actively in a new opportunity. So I think that's the great part of it, is trying to put everyone together. And so that's what we get out of the multifamily meetup, is education, ecosystem, putting a group together of like-minded individuals that are all trying to do the same thing, invest in multifamily real estate.
Awesome. Yep. All starts with networking and education, building your team. A little bit about the sponsor for tonight, apartmenteducators.com. This is our group here and some of our students at a recent event. What we do is provide a framework of education and coaching to show you how to go out and invest in apartment complexes as a passive investor, as a lead sponsor running the deal, as some variant of that. There's a place for everybody based on your level of interest and commitment and skill set, right? So there's a spot for everybody. And in fact, these larger deals typically do consist of a team. It's a team approach, right? So we provide that whole ecosystem. The education is one piece. The relationships that we can plug you into are another piece. The capital, so on and so forth, all the pieces that you need to go out and get it done. We have a very limited coaching program because we want to have a high degree of focus and attention on people getting deals done. So we've got a couple of spots open. If you're interested, you can apply by going to apartmenteducators.com. The agenda for tonight, real quick, we'll talk a little bit about myself and Abel, some background for those of you that don't already know us. We'll talk about why we invest in multifamily versus other vehicles, why we're underwriting deals and what underwriting is. We're going to talk about our underwriting model and what we look for there, and then we're going to do Q&A at the end. Little reminder here, at the bottom of your screen, there's a Q&A button you can see right there. And as questions come up, just start throwing them in the box, and we're going to answer them all at the end. But if we say something you want some clarification on, if something occurs to you, chances are somebody else has that question too. So go ahead and put it in the Q&A box, and we'll answer them all at the end of the presentation. Q&A is fun. A little bit about us, a little bit about my story. My name's Devin Elder. I'm the founder and CEO of DJE Texas Management Group. We've been investing in real estate in San Antonio for about 10 years. I'm a principal in close to 2,000 doors of multifamily. Valuation is over 130 million on that portfolio. I got into real estate out of the corporate world. I wanted a way to grow my wealth and have more control over my destiny, and that led me to real estate. And I'm here tonight versus other things I could be doing tonight, because everything good that's happened to me in real estate has been the result of some sort of a partnership or something that started somewhere. It could have been a mentor I had along the way. It could have been a partner I met, something like that. These deals are big, and they typically happen through partnerships. So We want to continue developing those partnerships. And just to bottom line it, if somebody does a deal with me in the future, there's a lot of money to be made for both of us. So that's great too, right? So that's certainly a part of being here. The likelihood that somebody ends up partnering with me at some point in the future for mutual benefit is very high. That's one of the main reasons we do this.
Hey, thanks, Devin. And my name is Abel Pacheco. I'm the president of 5 Talents Commercial Real Estate. A little of my backstory, I'm from Corpus Christi, Texas. I grew up there. I moved to San Antonio, Texas, so spent half of my life in Corpus near the beach, the other half here in San Antonio. Married, 2 kids, 2 under 2. And I've been investing in real estate since 2008. Had a great time doing it. I've had a full-time professional career, IT sales career throughout the process. And real estate has afforded me some amazing opportunities for me and my family. And, just from a real estate stat, I think we're invested in 4 apartment complexes, 2 as a passive investor and a couple as an active investor. So we have invested in 800 doors total in multifamily, and have throughout my time in IT as a sales leader, we were able to grow a business from 57 million, from 5 million a few years prior. So having that success there really pushed me to figure out how to create streams of income that were not solely dependent on a W-2 job. And I realized that, if I kept working, kept plugging away in the sales spot, man, quotas kept getting bigger. And unfortunately, if I stopped working, no income would come in. So that led me to multifamily real estate, and had a mentor and a coach, and appreciate all Devin's help. And so one of the reasons that I like giving back now is people helped me through the process and showed me how to do it, how to create more additional wealth for me and my family. So I love giving back. I love serving others. And then, as Devin mentioned, hopefully we get to partner with some of you all on future deals. And so you guys are a great source to look for other future partners and build a business relationship now and into the future. So thank you very much for joining. We appreciate you joining us. You're on mute, Devin.
So if you are relatively new to this and you're exploring multifamily versus other vehicles, why multifamily, right? Versus other options for your investment dollars. First is the returns that we're looking for. So cash flow while we're holding, and equity that we build in these projects, which can be substantial. You could come at this as a passive investor where you basically do nothing. Or you can come in as an active investor and do all the work, but then there's a corresponding compensation to that, right? So that's worth it for some folks. And then we're looking at tremendous tax benefits. And that's one of the leading reasons that a lot of people are in real estate, period, is because of some, frankly, kind of magical things in the tax code that we can just take advantage of that reduce our taxes. And finally, we have a safe asset. This is a real building, a real piece of land, an income stream. These are very tangible, real things. And that's a lot better than some investments where it's kind of ephemeral and can be at the whims of larger forces beyond our control. So it's a physical, tangible asset, and we love that.
Yeah. In addition, on the multifamily side, some of the benefits that you have in multifamily is if you are a professional, a high paid W-2 earner, and you're making good income, you may not have time to go invest in a single family property. You may not have time to renovate it, put it all together, do a rehab. And even if you do have time, you may realize that you make more money at your full-time W-2 job if you break down the hourly investment. So multifamily really provides the opportunity to invest as a passive investment vehicle where other experts, professionals, a team is running the investment. And then it also, as Devin mentioned, the tax benefit, when you look at your W-2 withholdings at the end of the year on your tax return, that number, that amount is what you're trying to avoid or receive back from the government. And if you can show real estate ownership with heavy depreciation, then you get to mitigate those withholdings and have a bigger tax return and have or pay no taxes at all and use that to invest in a future deal, which is unlike really any other single family kind of investment. So just kind of throwing that on there.
Awesome. So what is underwriting? It's going to help you as a buyer make a decision. You're buying a business with multifamily. You're not just buying a house to flip. You're buying an income stream, operating income, operating expenses, a bank note, and you're buying that, right? So it's valued as a business, which is based on an income stream. So you're going to do a financial analysis with your underwriting. You're also going to do a market analysis to see what's happening in the immediate area and see what is this property doing now, where can we take it to with the right attention. And underwriting is how you pull all that together and make the decision. This is not an emotional decision. It's just a decision about the numbers. You do the numbers, and the numbers will tell you what to do.
Yep. And Devin, you're really, as somebody who's done multiple acquisitions, you're really evaluating it, as you said, as a business. The underwriting is very similar to a new, a business that you would buy, right? You've got your income, you've got your expenses, and then, the valuation may be different, but it's not a real estate, single family deal. It's like a business, correct?
It's a business. So it's valued as such. The bank's going to look at your underwriting, investors are going to look at your underwriting, and you've got to have it make sense before you go into a deal.
Yep. You're definitely not jumping into a $5 to $7 million deal the same way you would analyze a single family property.
Right. Although you'd be surprised, I see some people jumping into $5 and $10 million deals, very unprepared. So that's good. Man. That creates opportunity for us.
It pays to have education and coaching and mentorship, man. I'm a believer.
That's right. That's right. So some of the underwriting terms, we got kind of a mixed audience tonight, so I don't want to blaze through it and gloss over this stuff if you're new to some of these terms. At the same time, if you've been around, some of this stuff might be kind of 101, but a couple of terms I want to cover at a high level here is a cap rate. This is a capitalization rate. It means what the property would produce as a return if you owned it cash. And what a cap rate allows us to do is objectively evaluate investments without looking at the loan terms, right? Without looking at bank debt. So that's essentially what it is. And cap rates are used to value properties, right? There's a little bit art and a little bit science to the cap rate, but essentially the way you can think about it is, what would this asset produce as a return if you owned it all cash, right? So if you owned the building and it produces a 6% annualized return to you, and you own it all cash, that property's got a 6 cap rate, right? And there's lots more to jump in on there, but I just want to give a high level. Rent growth is something we want to look at in underwriting because this is a big assumption, right? Right now, coming out of COVID, we're saying, hey, year one, we're not going to expect or project a lot of rent growth. Maybe year 2, year 3, et cetera. But we do expect some rent growth, and we can look at historically what's happened with rent growth within usually a submarket, right? What's been going on in this submarket? We don't necessarily want to look nationwide or statewide or citywide. We want to look at this little submarket, the properties in the immediate vicinity, what's happened with the growth of rent over time, and what can we do as good operators to push that higher. Value add income is another line item. So if we renovate a unit and we spend $5,000 to renovate it, and it used to get $700 a month, and now it gets $800 a month, that delta, that $100 is value add income. So we want to look at that in our underwriting and say, hey, what can we do to make this a nicer property, make it more attractive, make it a more desirable place to live, and have a corresponding rent, right? We want to look at expense growth too, because every year our rents are rising as a factor of inflation, et cetera, but so are expenses, right? So our taxes are going up, insurance going up, payroll's going up, and we want to make some general assumptions. Now, what we've done in the past is, hey, rent growth is going to grow 2 to 3% per year, expense growth 2 to 3% per year, right? So that's just kind of some rules of thumb on what you do with those numbers. NOI, here's the next one. This is net operating income. This is all of your expenses to run the property, operating income, right? I'm sorry, all your income with the property. So all your rents is the big one, but you might have other income like parking revenue or little things like that. Most of it's going to be rent, right? So you have all your rents and your income, and then you have all your expenses to run the property, payroll, marketing, taxes, et cetera. So you take all your operating income minus your operating expenses, and you're left with your net operating income. This is a very important number for evaluating what the property's worth, right? So net operating income is the name of the game in multifamily. It's the number we're all looking at. It's effectively the bottom line, although below, and you might hear below the line, if you're in multifamily or studying multifamily, you might hear, oh, is that above the line, below the line? Below the line means below, literally on a profit and loss statement, you have your operating income, your operating expenses, your net operating income, and then below the line is your debt service, right? If you're paying principal and interest to the bank. And it's also going to be your capital improvements. So that's the next item is CapEx. This is short for capital improvements. These are expenses that could be considered extraordinary or one time that are not recurring every month. So your payroll, that's going to recur every month forever, right? Your taxes and insurance, that will recur every month forever. But if you go and put $50,000 into the parking lot, it's really kind of a one-time deal, right? So there's a lot of repair items that are going to be classified as capital improvements. And when we go to buy a property, we're typically allocating a decent amount of money, sometimes $5,000 or $10,000 per unit to go do capital improvements because the name of the game is improving this, right? Then we have OPEX, that's short for operating expenses, which I've been talking about. And then our debt terms, and this just means the lender, what the terms are. What's our interest rate? Do we have an interest-only period that's going to reduce our costs? Things like that. What are the terms of the loan, right? How long until we have to pay it off? Can we exit early or are we stuck in it? Those debt terms are going to have a massive impact on our ability to do a deal. A deal that works at a 3.5% interest rate, if you're at a 5.5% interest rate, that's going to be a big change in your numbers, especially on these larger deals. You're going to see those numbers swing tens of thousands of dollars one way or the other. That's a high level on the underwriting terms. Abel, you want to jump in on any of that?
No, I think that's good. We'll probably break into each one of them as we're talking or explaining on this next slide. I think there's probably plenty to go through, but let me.
And be sure, guys, to put in your Q&A if you want us to define something or dig in a little deeper, because we're going to do that at the end of the call here.
Right on. So if you can go to the next slide. What I'm going to do is I'm going to try to summarize and make this as simple as possible. And then there are a lot of nuances. There's a lot of art in addition to the science. So we'll run through the underwriting kind of top to bottom quickly, and then probably dig into a little bit more. But at a high level, if you're buying a new apartment complex, you want to look at the number of units, buying a 100-unit apartment complex, and the unit mix, 1 bedroom, 2 bedroom, 3 bedroom, because each of those is going to draw different rents. So I'm going to keep this simple, and let's use a simple 100-unit apartment complex, and let's create that example that they're all the same. They're all bringing the same rents. In this example, you see $800. So you have 100 units at $800 a month, and this unit mix or this apartment complex will generate at 80 grand a month times 12 months, generate $960,000. That's what you would call the gross potential of this apartment complex. It may not be generating that when you purchase it, but you have the potential to create that. So now that you know that potential, the actuals are starting to, is what you're evaluating. You're saying, well, there's only 90% of these filled. So 90 units, there's 10 that are not collecting rent today. That's what you would subtract and say that's your economic vacancy. So 10 units, again, at $800 that you could gross, that's your potential. Multiply that, that's 8 grand, multiply that by 12 months, and now you're at $96,000 a year of NOI that you're not capturing. So you would say, okay, well, this apartment complex is generating a net rental income of 960, that's your gross potential rent, deducting your 96K of economic vacancy, and you're generating $864,000 from rents. Is that all that this apartment complex is generating? No, you can generate income from private yards, from parking. You can generate income from the laundromat. You can generate other small, amounts of income. But for this example, let's say you took all of that and you said you're creating an extra $3,000 a month. Well, multiply that by 12. The income for the year is 36K. So essentially, you're taking the $864,000. That's what you have in rents that your actual are actual, and now you're adding in your additional non-rental income. And go to the next slide here. So your total income, all of that summarized, is $900,000 a year. Now, when I take $900K a year, you have to run the property, right? There's expenses, there's payroll, there's property management, there's marketing. You got to get people in the door. You have to pay, commissions, apartment.com. There's all these expenses. And to make this very simple again, if the expenses were, say, 50% of your total income, then you would make $900K of total income for the year and deduct half of that for this example. And now your NOI, that's the nugget. That's what you're looking for. As Devin mentioned prior, how do we evaluate these? You're looking for that net operating income. If you take the net operating income, short math, divided by the total asset price, that will give you a cap rate. The cap rate, again, is what you're looking to, your total return of the investment. So the NOI number, 450K, that's what the pre I guess interest cost, before debt service, before your financing on the property. If you were a cash buyer, Devin gave that example, then I would purchase this with a cap rate in mind. If, for example, I'm not sure where you're at or what area, but let's say we're in an area that brings 6% return, then if I invested 450K, if I invested at a 6% cap and I paid $7.5 million for this property, my NOI is $450,000 a year, which is a 6% cap rate. If you take these bottom numbers and twist them around, it's a mathematical formula, as he mentioned. The heart and soul of this, I'm trying to generate as much NOI as possible. This property kicks off 450K. Simple math, my cap rate in this area is 6%. Divide 450 for the year, divided by 6%, and you've got a rough valuation of this property at $7.5 million. So you started at 100 units. You looked at your gross potential rent. You looked at additional less your economic vacancy. You added in additional income. Then you said, okay, well, what are my expenses to run it? You come out with an NOI. And then on the next slide, you can move over here. You're saying this property that's worth $7.5 million. How do I raise the value? What's the business plan? If, like Devin mentioned, you create an extra $75 of income per 100 units, you filled it up 100 units more. Well, maybe I'm trying to raise the NOI by 90K a year. Or maybe it's a mixture. Your business plan is reduce expenses because you think they're overpaying and you think you're going to generate more income. Then you're creating, for this example, $90,000 of net operating income, additional income. And if you divide that 90 divided by 6, now you just forced the appreciation on this property, this example, $1.5 million. So you were buying a $7.5 million property, and now you've got a plan to create an additional 1.5, so it's going to be worth 9. And they're like, well, how much do I pay for it? Man, I'll let Devin, I'll let you cover a lot of the nuances in how much you pay for it. But, there's a lot of different ways to get to that number. What's your plan? What are you going to get into? And how are you going to, force the rents up. But this property, if you figured out a way to increase that 90K of NOI, you're looking at a $9 million valuation. And so we went through this went through it fast. Now let me slow down. And Devin, I think you can probably, provide some of the additional meat here that people may want.
Yeah, so I first kind of want to say that we can't just raise rents, right? It's a marketplace. And so sometimes as investors, it can come across like, hey, we're just going to go in and raise rents. There's a ceiling on that, right? I mean, people are voluntarily renting places and there's competition, right? So it's free market and people are going to rent the best place that they can for the lowest price, right? So you can't just arbitrarily raise rents. We've got to create an attractive living space and improve it somehow in order to deserve somebody volunteering to give us most of their biggest expense, maybe not most of their paycheck, but the biggest bill for most people, right? So that's what we're kind of coming in here and doing. The short way to think about this is that if you can raise your net operating income $1, well, value is net operating income divided by a cap rate, right? So if you divide $1 of NOI by a cap rate of 6, 1 divided by 0.06, that's almost $17, right? 16.66. So that's really kind of the magic of multifamily is we have an incremental increase in our net operating income correlates to a massive 16x, 17x value increase, right? And that's why we're choosing this. One of the reasons we're choosing this as a business model. So let's look at this example here. If you could take the 100-unit apartment complex and make some improvements via spending some money, improving the apartment, improving the interior, right? And you could take that up $75. And we're just, to make math simple, right? We're saying we're to do that on all the units. That's per year is 90K, a 90K improvement to the net operating income, right? By raising the rents there. Or you could do a combination. Maybe you've got some rent increase and you got some expense decrease. It all drops to the net operating income, right? So if you could do that $90,000 increase, which represents a $75 rent increase, and that's going to take you to $90,000 net NOI, and divide that by your cap rate of 6, you got $1.5 million that you've added in value to this project, right? So you've done that through a relatively modest rent increase of $75 that you did put money into up front. You might have put $4,000 into the interior of that unit to deserve that $75 rent premium, right? Or there could be a case where the property is mismanaged, or rates haven't been keeping up with inflation, et cetera. But whatever the case is, the takeaway is on that $90,000 net operating income improvement divided by that 6 cap rate, you're able to add $1.5 million. And that's a really powerful number, right? Because, if we're trying to go flip a house, it's really tough to create $1.5 million of value, right? Maybe if it's, California or something like that. But in Texas, it's hard to create $1.5 million of value. It's hard to create $1.5 million of value in any business, right? But apartments lend themselves to be able to do this. What can you do with that $1.5 million of value? You can let it sit there. You can sell the property and take some of that value, return your investor capital if you have investors, and everybody makes profit. Or you can refinance it. And, really kind of the magic here is if you can do all this work and then refinance out and give everybody back their investment, and you still own it, still own the asset, everybody's got your money back, still cash flowing, which is just like this tremendous opportunity, and one of the really nice opportunities real estate gives us. So that's kind of an overview of how we're creating more value. We're not necessarily buying these things just to park money and forget about it. We're buying them to proactively make them worth more than we bought it for. And then we can either extract that via a refinance or realize it all at a sale. And hopefully we've got cash flow along the way while we're doing this. Another really nice thing about multifamily as a business model versus, say, like flipping or development, you get cash flow coming in from the beginning. maybe it's not optimal, but you have checks coming in every single month. The first of the month rolls around really quick. You know, I mean, we're at the 20th of the month, and I feel like the month just started, and we're already at the 20th. Rent's already going to start coming in again here in a couple of days, right? And so that's a nice way to do business because you've got constant cash flow. So that's kind of the overview of how we take that property and add $1.5 million to it.
Yeah. And real quick, Devin, because I don't want to gloss over this. A lot of investors, when they're talking about creating the additional value, how exactly do you do that? And it's, really when you demystify it, maybe you can talk about like an interior unit upgrade. How do you said you don't just raise rents by $75? No one's just going to pay more unless you were under market already. But if you've got a classic, quote unquote, a classic unit that looks pretty old, what are the things that you're going to do so people get it? Like, how do I raise the rent $75 in the interior? What do you do to the units?
It's really simple. Once you've done one, you've done them all. This is not, we've flipped a lot of houses too, with all this design elements and stuff. This is not that. This is going into a unit, vinyl plank flooring, looks like wood, it's tough as nails, two-tone paint scheme, gray on the walls with white trim, new fixtures. You're gonna put some brushed nickel lights, handles. We're gonna do a resurface on the countertops, make it look nice and uniform and new. We might resurface the bathroom tile, the shower surround. We're gonna try to rip out carpet where we can because carpet just does not wear well in apartment communities. And that's kind of it. Bonuses might be a backsplash. Bonuses might be putting new faces on the cabinets. Maybe we don't replace the whole cabinets because of cost, but we could put some new faces that make them look really nice and new. We might paint the cabinets. And if we're really going crazy, we might put granite and stainless in there, but usually not. Usually it's a black appliance, taking it from white appliances to black appliances. So that's kind of your value add. And once you've seen one, you've seen them all, right? But it really does create a nice, attractive product. Another one is plugs and switches, right? So you can get a cover that goes over the old outlet that looks brand new. You're not replacing the electronics. You're literally replacing the cover from that creamy kind of old school to a white, sharp looking white one that matches your paint trim. You do the same thing on the switches. There's literally a switch that goes over the old switch. You're not even replacing electronics. The maintenance guy zip, takes it off, puts the new one in, looks like a brand new switch. You go like this, boom. So these things all coalesce to give you this feeling that when they walk in with the leasing agent to go, wow, man, this feels updated. This feels fresh. This looks good. It's not 1980s. I was wanting, I was coming out of a kind of a dingy apartment. I'm paying $800 a month. This is $875 and it looks awesome. Sign my lease. Where do I sign? Right? It's not that hard to make that happen. What we're looking for too is a 20% or better ROI on those interior improvements, right? So if you're getting that, let's say it's $100 rent premium, that's $1,200 a year. We want it to be a 20% or better. So if we're spending $4,000 to do all that flooring and paint and stuff like that, we want our annual ROI to be 20% or better, right? So if you're getting $1,200 increase on $4,000, that's a 30%, right? $1,200 divided by the $4,000 you spent, it's 30%, which means you've paid for that in a little over 3 years, right? Anything under 20% ROI on that interior is kind of tough to swallow and maybe not worth it. You do the numbers, and the numbers tell you what to do. Anything over 20 might be good, and you might sometimes see much higher ROI numbers when you can directly correlate it to a rent premium. So that's what you're doing on the inside. It's definitely not rocket science. I've certainly worked with a lot of people where you have to rein it in. This is not your dream home that you're redesigning, right? This is something we're going to do, make it clean and nice and functional. And it's going to be somebody's home, and we're going to take pride in our work, but we're not going to go absolutely crazy. And sometimes that's a tendency for newbies, is to go crazy on the renovation. Look, if you could put in granite and stainless and you could see a corresponding rent increase, maybe that makes sense. A lot of times it doesn't, right? You want to do a minimum effective dose here. You want to do the minimum thing you can that's going to that's going to hit your numbers and not do a ton more.
And then, so to all of that, I think that's a great summary, because I've had some investors, actually say, hey, I'm going to go walk the property. And they looked at it before they pulled the trigger. And they said, I'm not going to invest in this deal. And when I asked why, it was, well, I don't know if I could see myself living there. And I go, man, you make 6-figure income. The last time you lived in an apartment complex, you were 19 or 20, 21, and they're trying to project themselves living there, and they're just not. That's just not the renter base. And then additionally, I think I have some investors that just, they don't realize how the rents are increased, and the actual value when you have a 20 or 30-year-old building that and in my apartment complex, old carpets, smells a little dingy, an old stove, it looks crusty in the restroom. Man, I don't want to go live there for $800, right? If I'm a renter. But man, for $875, an extra $75, I get a brand new interior that looks like, kind of a model home. That's what's happening, and that's how you do that. And that's why the investors like us are looking at this and saying, hey, well, I think I can pull that off with $4,500 a unit at the most, and I only have to improve 50 of them. And now all of a sudden we're looking at 250, 300K, 400K at the high end. But we're creating $1.5 million of value on the back end. It's just awesome. It's multifamily, it creates so much. So maybe as we keep talking about the underwriting, we can talk about this a little bit too, Devin, which is, the example we just gave, 100 units, $800, 960. You've reduced some of your expenses, economic vacancy. Now you're at the 450K NOI. You divided that number by 6% cap rate, and now you're at $7.5 million of valuation for this property. That's how much it's reasonably worth today. So how much do you offer? Or do you pay $7.5 million if that's what it's worth? There's so many nuances here, and I'm going to let Devin kind of jump in too, explain it more. But at a high level, $7.5 million, if you know you're going to have to improve 100 units, all of those units are classic, they're old, and you've got some landscaping, you need to take care of deferred maintenance. There's a slew of trouble tickets, those tickets, work orders that haven't been, corrected. There's plumbing, there's leaks, there's, you're saying, hey, I think it's going to take $600,000 to whip this property up into shape. New signage, outside looks nice, pool, interior, so it's $600K. And I know, if you look in the middle here, I know that I'm going to have to pay some extra fees, loan closing, origination, the lawyers. I'm going to have to pay the syndication expenses. I have to put all this stuff together. That's another $350K. So let's just say you're spending, on the property, it's worth 7.5, but there's going to be an extra $950,000 for closing costs and improvement budget. Maybe you're offering not $7.5 million, maybe you're offering 6.5, and you're explaining why this is the value, why I believe 6.5, and maybe the buyer takes you up on it, or how low should you offer? Man, that's all up to you and your track record, your experience, your ability to close, your reputation in the industry. All of those things are literally going to help you win that deal at the best price, because the brokers want to make sure that you can close. And if you can bring them that full package, team, track record, surety of close, expertise in this and ability to close it, they may be telling their client, hey, this offer is 6 million, but I would go with the lower offer, even though somebody else is offering 6.5, because I believe that this team can close it. I've worked with them in the past. And so there's some of the nuances. Maybe Devin, you can jump into that, but how much do we offer? $7.5 million. And how do we get to this offer price?
Yeah, it's definitely a negotiation, right? I mean, prices are never listed in multifamily. There's almost always a broker involved, or two brokers for each part, one for each party. There's going to be kind of a pricing expectation. depending on so many different factors. That's going to, I mean, every deal's different, right? This is why real estate works for the little guy, right? We're not Wall Street, because you can't commoditize apartments, because not only is every state, city, and city block different, every single asset is different, right? You get different seller motivations, different types of property management situations, different type of demographics. I mean, there's just so many nuances, which kind of keeps it fun for sure. Every project is its own, they're like my kids, right? They're all completely different from each other. It's the same thing with these properties. So your offer price is going to be a factor of, what do you think you can do year one after you buy it? What is the operating expenses going to be and your capital improvements, and what can you get it to over some period of ownership? 5 years is kind of a standard underwriting period for multifamily, right? So what can you do with it right away, and what can you get it to? And this is always, if you've got investors, this is always viewed through the lens of, what does this do for my investors, right? Anything else is secondary to that. So what is it going to do to cash flow for my investors? What is it going to do for total return to my investors? And that's the number that you're looking at, is dialing in those numbers to say, what can you make it do in the first year? And you want to buy on the actual numbers. Now, in the last few years, a lot of people have gotten away from this, right? Because the market's been heating up. We'll see what happens with the reset that we're currently in. I don't know that that's going to change pricing a whole lot. I haven't seen that yet, to a tremendous degree. To some degree, yes, but not to a tremendous degree. So you want to buy, as a buyer though, you want to buy based on what the property's actually done. Now, if you're buying a property that's 75% occupancy, and you know that the last year just looks terrible and you're not going to run it like that, you've got to basically convince the bank that you're going to do better, and why. And usually that comes down to spending money, addressing issues, and bringing in the right management team, right? So that's going to be a function. But your price is really just going to come down to, what do you think the property can do in the first year in terms of your operating, and where can you take it after that? And that's going to influence your price. And you may be in a position to pay more than somebody else. Somebody else, based on their situation, might be in a position to pay a lot more than you. And every single deal and negotiations always got some little wrinkle to it, or a little bit different. But the short, look at it is, what's NOI, net operating income, over we call it a T12, right? The past 12 months, or a T3. The bank might be looking at a T3. And you can, as a buyer, can look at a T3 as well. What's the T3 NOI? So if NOI was 50 grand for the last 3 months, right? 50 grand a month, you're going to annualize that. So 50,000 a month for the last 3 months, it's 150K. Times 4 to annualize it. Now you're at 600,000 net operating income. Divide it by that 6 cap rate, that's probably a $10 million property, right? So for the last 3 months, if they've generated $50,000 of net operating income, we can annualize that, divide it by our cap rate, we get a $10 million valuation on that property, right? And that's going to give us a ballpark of what the valuation is. Now, maybe we come in and we offer a little bit less because we've got to continue to do some improvements. Or maybe the property really is performing well, you don't have to do much, and you're going to make an offer that's closer to that. And that's really where you and your broker are going to work together and kind of fine tune and finesse this deal across the finish line.
And Devin, I know, so essentially we've tried to summarize this because it's a very detailed, in-depth, basically Excel, 100 Excel lines of all of this detailed work, because we're basically stopping at this value price. But Devin said above the line and below the line. Below the line, you're going to have things that are, as he mentioned, different from every buyer. My financing or debt financing may be better or worse than someone else's. And so that's going to affect your situation. How much capital can you raise to do the deal when we partner together? What's my loan to value on the deal? And, maybe property taxes or insurance, those are pretty the same, but there are these moving factors that are going to change. And so how do we, I don't know, maybe talk about the the stuff we're not seeing in this quick summary, man. You've got this long Excel, so I don't know how do we get there.
Yeah, I mean, let me just kind of share my screen here, and we'll kind of look at an Excel model here, right? And this is just looking at. You able to see my screen there?
Yep, we can see it. We're good.
And, the highlighted portions are portions that you would input, right? So what's our purchase price? What's our loan to value? How much of the purchase price is the bank giving us versus what we need to bring? What are our closing costs, for example? And then down to income and expenses. This gets detailed, right? Because these are real numbers that you're going to see on an operating statement from a property, right? So on our operating income, what's our gross potential revenue that Abel was talking about? How much rent could it gain if all units were leased? And then there's going to be some vacancy loss, collection loss, concessions, et cetera. We're going to have some other income, which gives us our effective gross revenue. And then we've got our operating expenses. And we can make some general assumptions around what operating expenses cost us based on experience with other properties and what's happening in the market. But it's a very detailed underwriting model here, an Excel model that you will build out these numbers in, and that's what you're gonna run the numbers on. And we didn't want to jump into this line by line on this call. I mean, with our apartment educator students, we'll do really deep dive on this stuff. We've got a class coming up next month on it that I think we're doing 3 hours on this, right? We're going to jump in line by line. But for the purposes of this call, we wanted to just give everybody kind of a high level overview of some of the things that we're looking at on underwriting in general. And that's what we're doing, is punching in all these numbers. And it's a challenge too, because these are assumptions, right? We didn't bake into our assumption last year that the world economy was going to shut down for 2 months, right? Didn't have that in the model. Now, amazingly, we were not that impacted, especially relative to other businesses. It's been incredible, really. It's been a real test of our investment thesis that apartments are a vital product that people need. And we're really seeing that, right? We've certainly had our challenges like any business, but not to the extent of so many other businesses. So my takeaway there is these are assumptions that we're moving into the future. But as business people, we all have to make assumptions. The bank's making assumptions. We're making assumptions buying this property on what we think we can run it for. And we want to give ourselves some cushion and not run these numbers high on everything. We want to give ourselves some cushion on how we approach that.
Yep. And this is where I believe, as a relatively younger multifamily, syndicator trying to become, more of that expert over time, you just don't get this, like, reading a book today and going to, to go, leave your deal tomorrow. You're not going to get it overnight. Nor are you going to get it on your own in a bubble, thinking, hey, I can go and accomplish this. I've went to all the classes, I've listened to all the podcasts, and I've done it. There's just something about experience over time, seeing multiple looks, seeing multiple deals get run under different circumstances at different times of the year during, volatile market conditions that we're under. And when you have a team, a really solid team with people around you that have seen more looks than you're going to be in a good spot. And I think that's, to kind of plug that, right? You said apartment educators will have the underwriting class. I'm excited for that, being a student and a former student and a coach now. But it's the ability to partner with experts, pros, people that I trust that have seen more than me. I think there's a lot of value in that. It's not as easy as just reading an Excel and saying, hey, I think this is the way to go. Man, there's a lot of value to coaching, mentorship, and guidance when you want to go invest. And also you're a financial steward. You're raising capital from investors, and you're trying to be, extremely careful with the trust that's been placed in you. You have to say, man, how do I get as many wise individuals to counsel me through this? And that's why mentorship, guidance, and coaching is just is phenomenal in this business, and it affords affords us the ability to have partners and pay and people get a good piece of the pie, whether they're passive investors or active in the deals. And so, it's just it's a testament to multifamily. Great teamwork.
Yep, that's it. There's some Q&A coming in. Please keep it coming. I want to address these real quick because we're almost at an hour here. And so question here, what brand of vinyl flooring do you use? Honestly, I haven't looked at that level in a while. I mean, I'm basically the CEO of our company. And so I've got somebody on the team making decisions on the vinyl, but we've gone with sheet vinyl before, and we've gone with vinyl plank. I want to say 8mm, but don't quote me on that. And then the brand is going to vary depending on what sourcing looks like, right? Can you explain how to figure out cap rate, I think is the question. The cap rate is kind of prevailing in the marketplace based on what has sold, right? And what type of assets has sold. So it's a little bit art and science, because you might say, yeah, properties in this area are trading at a 5 cap, trading at a 6 cap, trading at a 7 cap, whatever it is. So you're going to look at what properties have sold. And then you're going to negotiate that purchase price, and that will change your purchase price cap rate. So that's kind of it on the underwriting.
Sorry, maybe to add to the cap rate too, I think it's good to explain that cap rate is measured without debt financing. My cost to purchase this property, because if let's say we're a team and they give us a 2% rate versus a 4% rate. Well, the team that's buying with a 4% rate, that investment vehicle is going to pay more money and make less on the deal than a team that gets 2% interest rate. And the cap rate really doesn't look at your debt financing position. It doesn't look at the team's ability to get a lower interest rate or not. It just looks at the investment as its actual value, an income generating asset that generates, in this example, $450K of NOI every year. So that's why Devin said, if you buy cash, that's how that cap rate is measured. And it's literally a return. To make a number simple, if I was buying a $10 million property and we were putting $1 million down or $1 million in it, it's $10 million property, and I made $1 million back, that's a 10% cap rate. It would take me 10 years to get my $10 million investment back, and everything after that would be gravy if I was buying a cash. And so, we're not trading on a 10 cap right now. It's, the cap rate is very much compressed to like 6 in our area or for this example, and who knows what it will be in the future. But that's how you're saying cap rate is the measurement of your return for the investment of the investment vehicle without debt financing for this example.
Yep. And cap rate is a measure of attractiveness of an asset. It's not tied in lockstep to interest rates, right? It's how attractive is an asset class or asset itself. And that's why we've seen cap rates go down over recent years as more people find multifamily attractive as a cap rate. So cap rates are weird because a 50 basis point change can change the valuation by millions of dollars, right? It's crazy. That's the game we play. Some of the other questions here. How do you keep renovation costs down? Good question. You can buy in bulk. You can shop around different vendors. Rule of thumb is you always get 3 bids on anything. So you don't want to just go with the first vendor. You want to get 3 bids if it's an outside vendor. You're going to use your in-house guys, right? So if the maintenance staff on site can do something, and you don't have to bring in a third party, that's great. You might buy, a machine that you can keep on site to maybe do resurfacing or to do power washing. Instead of contracting that out, you might be able to do some of that in-house. So that's one of the ways to keep renovation costs down. But that's an important component.
And then also, one of the reasons we like 100 unit plus apartment complex, you're looking at as a business that you can hire a property manager for. And you're, part of probably the evaluation as a property manager is, hey, how many other apartment complexes are you running in the area or in my market? because they have great either buying power, negotiation power, the ability to help you at scale. Where if I was running this on my own, you know, I'm paying full retail for somebody that doesn't know me and has never worked with me versus the property manager who's got a good relationship with contractors and, you know, assistance and help.
Yeah, that's great. Question here, what do you mean by adopting an underwriting model? An underwriting model is just an Excel spreadsheet most of the time. There's different software, stuff like that you can use. Most of this is still getting done on some sort of a spreadsheet that you can put these numbers into. So I think we're about at time here. I think we're probably going to kind of wrap up, and I wanted to remind everybody of our next meetup is June 3rd. That's coming up before too long. We're going to do a noon meeting here, and our topic is how to turn $1 into 16 with apartment investing. You can register for that event at apartmenteducators.com/events, and be sure to go like our Facebook page. And we're going to wrap it up. My name is Devin Elder. Abel, thank you so much for jumping on. Everybody that attended tonight, we really appreciate it. Thanks for your time, guys. Hope to see you live at an event very, very soon. Stay safe.
Bye, everyone. Look forward to seeing you.
Take care.
Bye-bye.